Good morning and welcome to this Monday, November 21st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, options expiration is in our rearview mirror, at least for this month, although we could still have some lingering effects into the early part of this week. I think that may have something to do with futures down a little bit this morning. Nothing huge, but we are looking right now at the Dow opening down about 30, S&P 15, NASDAQ a little bit more on a percentage basis, about 60. But keep in mind, that's where a lot of those companies are that might be subject to max pain and options expiration. So I'm not surprised to see that index down a little bit more. It was really weird last week because the 10-year Treasury yield, of course, has been on the decline, and yet many of these growth stocks didn't really do much to the upside. And I thought that was interesting when you consider max pain and the fact that a lot of these growth stocks are the ones most impacted by options. So I don't know. We'll see what happens, because right now we do have the 10-year Treasury yield sitting at about 3.8%. That's a far cry from 4.3% where we were not that long ago. So whether or not the growth stocks begin to pick up once we get max pain out of the way, that remains to be seen, but certainly could be the case. Crude oil down about 60 cents per barrel. It's down to 79.50, so it's back below 80. Anyhow, that's how we're going to get the week started. It is Thanksgiving week. For those of you who are going to be traveling this week, hopefully you will do so safely. I do also want to mention, because of the holidays, our schedule will adjust a little bit throughout both the Thanksgiving and Christmas holidays. But for this week, we will have no Trading Places Live on Wednesday. So this is the last one of the week here at Earnings Beats. Of course, the market's closed on Thursday. Like many of you, some of us have travel plans heading into the holiday weekend. So as a result, we will not have a Trading Places Live show on Wednesday. So mark your calendar for that. Other than that, I mean, I think the market's going to be pretty quiet. There are no economic reports, or none of any significance, until Wednesday, and we jam a bunch in on Wednesday. I'll go through those in just a minute. But let's go ahead and I'll take you over to Earnings Beats. We'll get this thing started. For those of you who are new to us and new to Earnings Beats, if you go to earningsbeats.com, a couple things I want to mention. First, we have a free newsletter. We'd love to have you join. It's a 3 times a week newsletter, very simple read, just a couple paragraphs and a chart. Normally we try to get it out sometime around 8:30 in the morning, so it's about an hour before the stock market opens, 8:30 Eastern, of course. Focusing on the things that are important to us: earnings gaps, relative strength, candlesticks. This morning I wrote about seasonality on Netflix, which is absolutely loves this time of the year. Does pretty well in December, but then absolutely just lights it on fire historically in the month of January. And Netflix recently did break out, so it's starting to look better technically, and we know seasonally it is heading into a strong period as well. So there's a lot of different things that I could write about on that newsletter, but I think you'll find it interesting and hopefully learn some things along the way. I also want to mention that last week we redid our portfolios. So on Thursday, we announced which stocks that we would have in the portfolio, and we did it a day in advance because all those changes took place at Friday's close. But right here we track. So if you ever want to come in and just see how we're doing, you can do that by clicking here, come back. This is the stock portfolio performance. We have 3 portfolios. Then we have an ETF portfolio also. And you can see how they're doing both in the current quarter and then also since inception. Just keep in mind that our quarters, you can see the asterisk there, our stock quarters run, this one just ran from August 19th to November 19th. So the next one will run from November 19th to February 19th. We deliberately do it this time of the quarter because that's when most earnings reports have come out. And fundamentals are a big part of what we do in putting together these portfolios. So we like to see what happens with the earnings reports. And then once the majority of them are in, that's why we've just selected this date. It's not completely arbitrary. But anyway, so in this last quarter, you can see our portfolios were down, but the S&P was down 6%, and we're always 100% invested. So we don't try to time in these portfolios. We don't try to time the market other than getting into the portfolios that we want to every 90 days. So we swap them out every 90 days. Anyhow, pretty good performance on a relative basis. I mean, model portfolio was up more than 4 percentage points above the S&P 500. Aggressive was flat, and income was about 2.5 percentage points better than the S&P. So it's a good quarter. So far, our ETF portfolio is doing well versus the S&P. Notice this quarter is different here because we started this one October 19th, and this one runs through January 19th. So it's a little different time frame. That's why the quarters will show different results. Anyhow, you can check that out at any time. Let's go ahead and jump into the action from last Friday. How do we close out option expiration Friday? Well, the Dow Jones was up 199. S&P 500 was up 19. NASDAQ was up 1 point. So you can see the relative performance, not quite as good on the NASDAQ. I think a lot of it was because of the huge move we had up in the prior week, that Thursday and Friday after the CPI came in better than expected. We had the huge move to the upside, and we actually went from a market that had a lot of net in the money puts to a market that all of a sudden had a lot of net in the money calls. And so heading into last week, it actually behooved market makers to use their capital to influence prices to the downside. And that's what we saw really throughout the week. It wasn't a huge move down. It wasn't a high volume move down or anything. We saw volume pretty much, moving down below average. But that actually helps market makers in terms of influencing the direction of market prices. Mid caps up 16, small caps up 8. So again, everything was up to close out last week, but we did finish pretty strong at the end of the day. Price action relative to the moving averages, I think, looks pretty good across the board. PPOs look good. They're all above the center line and rising. So we're seeing more and more bullish momentum. That's been good. And the AD lines, you can see the Dow moving back up, getting close to a breakout. The S&P and NASDAQ a little bit further down. Mid caps, small caps. I mean, it wouldn't take much for all of these to have new highs on the AD line. So watch that. I can tell you that in prior secular bear markets, and there are some who believe we're in a secular bear market, and it's we live in a free world. You're entitled to your own opinions. Everybody, the market's made up of bulls and bears. I don't believe we're in a secular. I said beginning of the year, I expected a cyclical. I think we're done. I think the cyclical bear has ended. I think we're going higher from here, but that's just my opinion. Everyone's entitled to their own. But what I wanted to say here, though, is on the AD lines, if you do believe this is a secular bear market, the last 2 secular bears, we've seen that AD line go down considerably about this far into the bear market. So in other words, if the market takes another move to the downside, you should see that AD line really beginning to drop. That would be confirmation, in my view, one of the signs of confirmation that I'd be looking for. I mean, if you're gapping down and you're being bought up during the day, that's what keeps your AD line high. If there's intraday buying. In bear markets, you have distribution. You should have a lot of selling intraday. So you got to watch those AD lines. Anyhow, from a sector perspective, utilities led. We saw defensive groups leading, but again, with Max Payne, I'm not too surprised. There were a lot of areas within technology and consumer discretionary and even energy that needed to come down because they had been so hot. And there's a number of options on those companies within those sectors. So anyhow, utilities, real estate, healthcare, staples, the 4 defensive groups led on Friday. The laggard was energy. And I've been talking about energy. I mean, the most recent high, you can see the PPO rolled over. That's suggesting to me that the momentum to the upside has really slowed. And normally when we see this, we go back down and we test the 50. So I wouldn't be surprised to see energy moving back down, maybe closer to that 85, 84, 85 level to test that breakout right there. All right, 10-year Treasury yield. Let's go over some of these economic reports that'll be out later this week. So on Wednesday, nothing really next 2 days, and not really much from the Fed either. Not many scheduled talks from the Fed, so that probably should help as well. But on Wednesday, we've got durable goods. Initial jobless claims moved to Wednesday because of the holiday on Thursday. New home sales, consumer sentiment, and then later in the afternoon, FOMC minutes come out at 2 o'clock on Wednesday. So a lot happening on Wednesday, but it'll be a quiet day. A lot of folks traveling for the Thanksgiving Day holiday here in the U.S. So I imagine that we're going to see things very, very light in terms of volume this week. There's not much news. There's not much earnings. Earnings have really slowed down now. So there's just not going to be a whole lot to trade off of other than just technical conditions and the seasonality. We are beginning a very, very strong seasonal period from now, from now through December 6th is a very strong 2-week period. Doesn't mean we go up every year, but seasonally, historically, we do have a tendency to have a pretty good period here. So we'll see whether or not seasonality holds true this year. What else do we have today? Well, I mean, looking at the 10-year Treasury yield, let's get an update here. Right now we're sitting right at 380. We are trending lower. Anytime I see the PPO go below the center line, the yield now is below the 20-day and the 50-day. We're about to get a cross on the 20 versus the 50. Right now, the 20 is sitting at 391, and the 50-day is sitting at 387. So they're getting closer and closer. We get one more move down on the 10-year Treasury yield, and I think we're going to see that death cross, which is when the 20 crosses over the 50 to the downside. I'm watching the 20-day because with this breakdown, a lot of times what you'll see, whether it's the yield, whether it's stocks, whatever it is, many times once you break down, you go up, you test, and you fail at that 20-day. So that 20-day, again, is at 391 right now, 3.91%. So just kind of keep that number in mind. I think anywhere around 390, 392 in that range is worth keeping an eye on. Remember, the breakdown, if I use this inspect button right here, this breakdown, we went down to 391 right here. That was October 27th. And then 3 trading days later, which was November 1st, we hit a low of 392. So there's your 391, 392 resistance. There's the big breakdown. And so now, and there's a reaction high right there to 390. The 20 days at 391. So getting back through 391, 392 would be fairly significant in the short term based on the overhead resistance that we have right now. And this has been very instrumental, the 10-year Treasury yield, in how the market has performed this year. Higher rates have been driving the stock market lower, and higher rates have been sending money rotating away from value, away from growth and into value. Growth stocks have had a very, very difficult year. Just ask Kathy Wood. Or pretty much anyone that's running a growth fund. It's been a tough year for growth stocks. Good news is if this continues, we're going to see a big move up in growth stocks, in my opinion. That alone, forget about the economy. This alone, rates coming down, will send valuations much higher. Much higher. There are a lot of companies that got crushed this year. And if you look at their fundamentals, they may have slowed their growth a little bit, but it hasn't been that bad. And yet you see many of them down 50, 60, 70, 80% on the year. A lot of it is the fact that rates have gone up so fast. I mean, a year ago, we were looking at 135, 130. We're up at 430, 300 basis points in 1 year is a lot in terms of the impact it would have on valuations. Most valuation models use current interest rates to discount back future earnings, future growth rates and earnings that are projected. So there's really, a two-pronged issue here. Number one is obviously earnings. I mean, if earnings growth rates slow, then we should see the market, decline. Valuation should come down. But the other part of it, and this is what I think has been the bigger part of it, has been the ascent of interest rates and how fast they have moved to the upside. It's been a crusher. All right, S&P 500. So right now, I've been telling our members, I believe we're in an uptrend. And I am going to trade based on the fact that I believe we're in an uptrend. If that changes, then obviously the strategy changes. But anytime you are in a long-term secular bull market, and for those of you who haven't seen this chart, you probably haven't been watching anything I've been doing. But this is a chart almost every webinar, key webinar, anytime I talk about the overall market, this is a chart that comes out, because this is one that I never lose sight of. It's like, being out in the ocean and not knowing which way the current's going. That would be the similar. I mean, whichever way the current's going, that's the way you're going to go. Chances are, if you don't do anything, if you don't paddle, you're going to go in the direction of the current. Well, the stock market, when you get into these secular bull markets, unless you hit little turbulence, a cyclical bear market like we just went through, these secular bull markets are powerful, and you really don't want to bet against them when the market starts to get a little wind at its back. And, those of you who think this is a secular bear market, maybe it is, but all I can say is that if this turns out to be cyclical, I want you to go back into some of these prior secular bull markets and look at what has happened after we have bottomed in cyclical bear markets. 1960s, we had a few of them, but look at what happens when we hit the bottom. We just soar back up, hit the bottom, we soar back up, hit the bottom, we soar back up. 1987 crash, we soar back up. 2011, or no, this is 2015, 2014, 15. Remember, we went sideways. We never went down 20%. So technically, by definition, it wasn't a bear market, but it didn't feel very good beginning of 2016 when we were hitting 2-year lows. But when that ended, straight up. How about the 2018 cyclical bear market? Trade war went down, and then once we hit that bottom, straight back up. How about the pandemic? Hit the bottom, straight up. I mean, every one of these. So if you're thinking it's secular bear, just make sure you're considering the possibility that this just takes off again. I think it's going to, but again, that's my opinion. Anyway, looking at this chart brings this chart more in perspective, because if I'm right about this being a cyclical bear market, when we go up, and we did this, I thought this was the bottom, and we were going straight up back in July and August. I thought that was it. I was really surprised, honestly, that we went back down. And if it weren't for Mr. More Pain Ahead, Powell, he's another kind of pain, in my opinion. But anyway, if it hadn't been for that day, which completely changed the chart, I mean, we broke back down below the 20, went back down below the 50. The PPO turned back negative. At that point, everything had changed again. Drifted back down, went a little bit lower below the June low, but now again, we are trending higher. Like, if we go back down below the moving averages, go back down below this gap support, PPO turns negative, hey, the bears will be back in charge at that point. But I'm not assuming they're going to get back in charge. I'm assuming that they're not going to get back in charge. And that's the way I'm approaching the market right now. Win or lose, I believe that there's much more risk to being short in this market than being long. Everything's changed. I mean, yeah, we bounced here and we failed. We bounced here and we failed. We bounced here and we failed. So why is this one any different? Well, look at sentiment. Number one, I mean, when we started the year, we needed to continue selling. Nobody believed that we were going to go down. I mean, now I'm getting a lot of criticism for calling bottoms, but I was getting all that back at the beginning of the year for calling a top. All the bulls were mad at me back then. Now all the bears are mad. I don't care, honestly. I just call what I see. But just be careful. I think this market could go a lot higher than you think. And the 10-year treasury yield is probably going to be one of the biggest clues. All right. Here's the NDX. Not really a whole lot to add. Pretty much the same kind of a chart. We've moved up above the 20. The 20 is just now crossing above the 50 on the NASDAQ. We've seen this. This is a golden cross. So I talked earlier about the death cross, which is where you go below. The 20 goes below the 50. In this case, the 20 is coming up and going above the 50. And that's what's called a golden cross in technical analysis parlance. What else do we have here? Well, I mean, we've set the high, that gap up just above 12,000. That's going to be the short-term resistance I would be watching for here. To the downside, watch gap support. This was the Thursday when the CPI report came out, and we opened at 11,350. Both moving averages, 11,383 and 11,425. So if we go back down below 11,350, we will have lost both moving averages and gap support. That would be worth noting, and that certainly would change the way I would approach the market right now. And then the high that opened that day was 12,006. So that's really the range, 11,350 to 12,006. We'll see which one goes first. My suspicion is that we're going to take this high out. Sentiment has certainly changed. Seasonality over the summer. One thing that's different is the summer usually isn't very good for stocks. I said back at the end of October, from the October 27th close to the January 18th close, the S&P 500 has finished that period higher than it began 62 of the last 71 years. 62 out of 71. It's not 71 out of 71, but 62 out of 71 is pretty strong odds that we're going to finish the period higher. That doesn't fit into the theory of this being a secular bear market. So you got to fight the sentiment war, which has changed. Everybody's bearish now. That's a big difference from where we are now versus where we were at the beginning of the year. Beginning of the year, nobody thought we could go down. Now nobody thinks we can go up. Awesome. That's what you want to see. When I said we needed a sentiment reset in January, this is what I was referring to. We have reset. We'll see. Next thing I wanted to mention. Well, first, let me just show you this home construction chart. So last week, we did not have very good news on the housing front. And we do have new home sales coming up this Wednesday. But we made a big breakout with that CPI report when it came out, because, of course, rates came down, which is a nice bonus for home construction. But if I change this AD line down here and we look at the relative strength of the home builders, the relative strength of home construction has been going up since April. While rates go, well, I already changed that chart there. There we go. So this is what rates were doing. I mean, this was back at the beginning of April. Interest rates were 10-year treasury yield was around 2.40%. While interest rates went from 2.40 to 4.3, almost 200 basis points higher, home construction was quietly outperforming the S&P 500. And I think when we get a breakout above 1,300, we're off to the races. And not to mention, this is one of the crazier things, but if we look at the home builders on a seasonality chart, well, this is the last 5 years in November. It's been up every year. How about 6 years? Still up every year. 7, 8, 9, 10, 11. Okay, so the last 10 years, home builders have been up in the month of November. And if we drag this back all the way back 20 years, look at the 3 best consecutive months for home builders. November, December, January. Who would have thought that? If you think common sense, you think home builders probably really get going in March, April, May, June, you know, when the warmer weather comes in, people start getting out looking for homes. And that's when you would think, you know, if you're just maybe thinking from a common sense perspective, but stock market looks ahead. and the stock market prices starts to build the prices up in home construction stocks during the winter months. So again, if you're looking at this chart and you see that it's already showing relative strength and it's trying to move to about a 7-month high above 1,300, all the bad news last week staying above the 20-day moving average, I think we're going to get a big breakout here. I really like the home construction group right now. I like what they're doing. I like their volume trends. I like this relative strength. We get that breakout above 1,300 and get that relative strength breakout as well, we could be on another November to January roll. All right, last thing I'm going to talk about is I want to mention this bullish trifecta chart list that we have at Earnings Beats. So what we do a lot of chart lists. If you're a member, an extra or pro member at Stock Charts, all of our research, these chart lists, you can just download right into your account. So it is an added bonus if you're a Stock Charts member. But even if you're not, you can still view all the charts. It's just that you have to view them one by one. You can't run scans against them. There's a lot of advantages to being able to download these into your account. But the bullish trifecta, the way you get on this chart list is you have to be on 3 other chart lists that we do. The strong earnings chart list. So you had to have beaten Wall Street estimates as to revenues and earnings per share in the last quarter. You also have to be on the strong AD chart list, AD meaning accumulation distribution line. If you've got a strong AD line, and I mean, that basically means you're being accumulated during the day, and you've got strong earnings, so you got strong fundamentals, and then this is the raised guidance chart list. So if you're on all 3 of these chart lists, you've raised your guidance, you've beaten last quarter's revenue and earnings per share estimates, and it appears the stock's being accumulated. If you meet all 3 of those criteria, you hit our bullish trifecta chart list. And this chart list, if we edit it first, you'll see there's only 65 stocks on it. It's not easy to do these 3 things. 65 stocks on this list right now. And if I go back to the summary and we pull up, we'll look at 3 charts, and that'll be the 3 you must see, and then we'll wrap the show up for today. Really not much in the way of earnings. I'm just going to skip through earnings. Not much going on there this week. So just pulling this up in summary form and then ranking it by scooter. If you bring it up in summary form and you don't see this column, go over here and click on columns. This is the way you can add or take out various, you can filter however you want to filter the list. But anyway, scooters is the Stock Charts technical rank, and that is just an indication of relative strength at Stock Charts. That's their formula. John Murphy developed it. I think it's a really good formula. I think, like everything else in technical analysis, it has its limitations. The biggest limitation with the scooter is that it only looks at how stocks are performing relative to one another over the last 5 to 6 months. So if you're looking to see if this stock's been doing great for the last 2 years, the scooter's not telling you that at all. In fact, it could be down 90% from 2 years ago. But if it's been doing well over the last 3 to 6 months, then it may have a very, very strong scooter score. So just keep that one limitation in mind. But here, I mean, we got all of these stocks that are, 90s, 95, 99, and almost all of them have scooter above 75 to 80. But there are some that are weak. And this is kind of interesting because you got these 2 software stocks down here. Obviously, they've not been performing well because their scooters are so low. Let's take a look at these 3 on the bottom, these 3 software stocks. This will be the 3 you must see. And just realize that they have all beaten revenue and earnings estimates. They've raised their guidance, and they appear to be they appear to be accumulated. That's weird that they would have a 13, 15 scooter score. So let's see what they look like. So the first one here is Elastic, ESTC. I see a potential bottoming head and shoulder pattern, but it hasn't confirmed. we need to get back up and go back through $68 with some volume. But look at the AD line. Prices, we just went back down to a new 52-week low, and at about the same time, we had a new 52-week high on AD line. Now, I don't buy stocks just because they have a strong AD line. This is a secondary indicator. So when I look at this, I'm not going to ignore the fact this has been an underperforming stock. I mean, look, software has been going down. This stock relative to software has been awful. So it doesn't really make sense that it's under accumulation. So I wouldn't buy it because the AD line is strong. The chart says, don't buy me. It's screaming, don't buy me. But it is screaming potential bottoming head and shoulder pattern. We need confirmation. Then the other one that I wanted to show you, or one of the other ones, Snowflake. Let's pull Snowflake up. Same thing, by the way, back down near lows. Look at the AD line. I mean, it really, AD line took off with this move June through August. And that's when I thought the market was really going to go. But when we rolled back over with all the Fed talk and the more hawkish tone, that's when this, among many growth stocks, rolled back over again. But the stock continues still to hold on to this AD line support, even though we've been drifting lower and lower. So I think again, it's an interesting point, but you've got to see better action on the chart. Now, if I see a breakout, I'm going to like this stock because the AD line is completely supporting a move back to the upside, but I'm not going to assume it's going to happen. I need to see that move. All right, last one I'll show you. Then the market's open, so we can take a quick look. Last one I'll show you is, we got Manhattan. How about, I want to do Autodesk. That's a bigger company. Let's see what Autodesk looks like. Well, Autodesk has overhead resistance at about 235. It's back down to gap support right here. I mean, this is an interesting level right now for Autodesk, to be honest. AD line has been pretty strong. I mean, we set the high back at this high. Even though we were lower here, still went back up to that level. We're holding support on the pullback. That looks good. And this chart actually looks a little bit better to me than the other two. And if it can hold this gap support level, it could easily go right back to the 230 area. All right, let's see what the market's doing. Assuming that we are down. That's what futures were pointing to. Actually, not bad. Dow up 93, S&P down 6, NASDAQ down 38. I would watch this week to see if the NASDAQ begins outperforming again. That's going to be critical along with that 10-year Treasury yield. If I'm right and growth stocks underperformed last week, excuse me, because of Max Payne, that should begin to change this week. With rates down from where they were, I expect we're going to see a rally, probably a pretty big one in the NASDAQ, but we'll see. Anyway, that's it for me. I appreciate everybody tuning in. I do want to mention again, one more time, that we will not be doing the Trading Places live show on Wednesday. So our next show here at Earnings Beats will be next Monday. And then tomorrow, of course, you can go over to Stock Charts TV at 9 o'clock and you can tune in to a recorded version of Trading Places tomorrow morning, 9 a.m., as I said. Last thing I want to mention, too, is if you go to Earnings Beats, the homepage, we do have our fall special. This is the best deal we offer all year long. If you have any interest whatsoever, try us out now. And then if you like the service, extend with the best deal of the year. Everybody have a great day. And if you don't listen in anymore this week, please be safe over the holidays. And we'll get back together right here at Earnings Beats next Monday. Happy trading.